All right, welcome everyone. Quick little tutorial here, what we covered at the CME group the other day, and I shared this algo page with everyone. We over here, if you look at this bottom page, you have what we call the high close doji, the person HCD, written about it in many books. Of course, Copy wrote that in a book called Candlesticks and Pivot Point Trading Triggers. A lot of people look at that. Second off, look at this, PPS buy signal. So what do you think? The market's, I mean, it's not going up, but it's in a buy mode. We have an uptick in OBV. We have a strong buy uptick in support of volume here. And then look at this, another interesting little analytic tool. It's called open interest. Open interest is kind of inclining. So when you have a positive direction idea that the market can go up, turn longs only. So this is long only crude oil. This is short only. And I'm just going to share what's on this screen. This is a 5-minute long only, 5-minute short only. This is a 2-minute, takes both, and this is a 15 that takes both signals. Now, let's take a look at long only because that was our focus. And then for today, quite a dynamic trade. And when I say dynamic, you know, the system is designed to get us in. You can see this is the entry. Here's our risk. Here's the first profit target, the blue line. So it's designed to get you out of half your position and then trail the stop at the balance. So that function right there turned out to be a whale of a profitable trading day for us here. Took another long, gave it up, took a little long, took a little small loss, but overall, a very positive day today, exclamation point. So the point is, and even if you take early morning systems, a little buy signal, if you understand that the market dynamics is in a higher degree time frame buy mode, then stick with buy signals. All right, next, let's move on to the tweet about the Qs because I was giving this intermediate class introduction on using the person market catcher as well as looking at some other indicators. So let's at least share with you what was going through my mind when I sent out that tweet this morning, as well as talk about in the trade room about doing this September 21st, 180, 173, 7-wide put spread. And I'll go and work through those dynamics with you right now. All right, let's take a look at the 15-minute chart. And you'll notice that as the market was opening up and gapping higher in the first hour, we developed a PPS sell signal. So the trend of the market gapped higher. That's a really bad arrow. My bad on that one. So we gap higher, we go up, and then all of a sudden we generate a PPS buy signal. Look at the volume on OBV relative to past highs, relative to past high value readings. You can clearly see that this opened higher, and after a period of 5 or 6 bars, you would have at least, if the market was going to catch up on strong volume, we would have anticipated to see higher volume. We didn't. And so what I wanted to do was scale in lightly to a position going into September, because longer term analysis is suggesting that somewhere between, you know, my initial target's around the 185, call it 84, call it 86, somewhere up there. Well, sometimes we might come close to that number and fail. So it's only the beginning of the week. An old school trading for position trader told me once, and I share this with a lot of people, is scale in best price over time. That makes sense. So if you're going to do a swing trade, get in some at the beginning of the day and then maybe add as you see confirmation how the rest of the day is going. If you get in on the open and get in on the close, you don't get the best price, you get the best average price of the day. Same can be said on a weekly basis. So it's only Tuesday. I don't know where the market's going to close by Friday, but I do know as I take you to some of our other work here and we look at the advanced decline analysis on the Qs, we can clearly see the NASDAQ composite has gone up, made new higher highs in price, where the advanced decline is not. So that right there is a warning sign. Volume is starting to trickle lower in the on-balance volume. Now let's look at the Qs, because that's what we're trading, right? The advanced decline was not making a newer high today as price was making a newer high. That's a little divergent. Also, look over here in the Russell. We had lower breadth readings, and we had at one point higher price readings. Look at the volume. Same thing. It's starting to diverge. So there are some cracks in the eggs, so to speak, developing here in the marketplace. One day does not post a top in the market, but I think what I was trying to illustrate is that by September, and for this, let me bring in my Thinkorswim. platform and go over that idea of what we were trying to introduce with that option strategy. All right, so from this morning, when we first put out that tweet, we were in the trading room, and one of the things that we were talking about is if you take a look at the implied volatility and look at the September 21st, we go from like 16, and all of a sudden, as we go out in time, you start to see the implied volatility, increase. Well, there's more activity. Implied volatility is a measurement of what? Demand, bid and ask, and activity in a particular option. And as we go forward, it seems that there's obviously a higher implied volatility, greater risk that things can go south over time. But one of the things that I wanted to point out was if I'm thinking that between now and the end of the month, not many days away, if I'm thinking between now and the end of the month and over time, we start to develop a sell-off, and not a big correction. If you get a 2-3% correction sometime in the summer, third quarter is generally the weakest. We're hitting this peak earnings season for the second quarter right now, this week and into next week. And we have some, as I just shared with that advanced decline analysis, if the market does roll over, I want some time on my side. So I also want to be fairly close to the money and within reality, what I call the realm of reality. So let's take a look at the market. I want you to look at this column right here. This is volume. Today, this morning, one of the things that we wanted to do was either buy outright on a higher price level. We were calling for it. We talked about this at the Traders Expo. I said, if the market goes up, I want orders working. After all, that's what we wrote about in our weekly thoughts and observations. In fact, I talked about this nearly 2 weeks ago, and here's the thoughts and observation, track record intact. And as we go through here, it pretty much says, listen, I think there's upper resistance level, and we should, if the Qs reach near 184.5, 186 within the next 10 trading days. Now, that was written about 8 trading days ago. So what I'm saying is, it was right around this time. I said, look to buy. If we get there, then we should see the Sep 21st expiration 179 strike put option. Get in that for around 290. Now, I was saying that probably you get when it gets up there, if the Qs get up to that 184.5, 186 range, the delta on that option will drop to probably maybe a negative 34, which indicates it's a put. Also, if you notice here, I said we can also look to buy a bear put spread using the 180, 175, a 5 wide strike. So it goes 75, 76, 77, 78, 79, 80. 5 strikes wide. We call that a 5 wide play. And we were looking to place and get into that trade for 117. All right, so what happened? Well, this morning the market opened up and the conditions changed. The volume wasn't looking great. The advanced decline wasn't looking great. And I go, we got a high of 182. And we noticed that the 179 strike, they had a low of 306, not far off that 290 number. So in addition, I started to see more and more volume come into play in the 180 strikes. Look at this. Volume today, 8,900. And then all of a sudden, you look down the option chain, 170, 22,000, big number. So there were bigger numbers on the short side of the Qs than on the long side going out in the calendar month of September. So I said, you know what, let me take a look at this because we're also starting to see an increase in volume on the 73s. And I thought that maybe someone else got a good idea, and it looks like there's the 180.75, a 5 wide strike play. And I looked at the difference at the time between the 180 and the 173, which is what I tweeted out, for $1.60. They went down to 154 after I sent that tweet out. So it's a pretty cool thing. So if we take a look at analyze in the trade, and you look at the strikes of the 180, 173, here's the overall expectation of what we can expect. If the market by expiration, somewhere below 178, 177, I mean, obviously we're gonna max our profit out at around right here, 173. So it doesn't matter whatever the profit gets to, we can, even before expiration, profit on this trade. So I thought it was a nice trade. We're already in the money on it, filled at 160, and guess what? Things settled off at around 188. So not the greatest, biggest winner in the world, no, but we caught the right trade at the right time, not picking a top, but using the methodology that we have been teaching for decades. A, pivot resistance. B, weakening volume rally, and then deterioration of the advanced decline. All that added up to, hey, now's the time to maybe initiate a trade on the short side, or at least have a respectable option position. That pretty much sums it up. I hope you enjoyed this outlook on what we were looking at and why, and a follow up with you guys on what we were looking at with that tweet. Have a great trading day. And again, I really enjoyed visiting a lot of folks here at the Traders Expo in Chicago. I mean, there were just an amazing amount of I wouldn't call it fans, but more friends that have been past students that have just been great to know you guys through the years. With that said, we'll see you next time. Thank you.